Is now starting. All attendees are in listen-only mode.
All right, good afternoon, everybody. Welcome to our once every 3 weeks members only workshop here at Investors Observer. Yeah, this disclaimer is pretty standard at these kinds of things. Nothing you see today is an offer to buy or sell securities. And yeah, you can read the rest of it. All right, if you have questions at any time, put them in the question box. I have that open in another window here. And if it's relevant to what I'm talking about in the moment, I'll typically stop and try to answer it. Otherwise, there will be some time for Q&A at the end. All right, so what we're going to talk about today is what's going on at Investors Observer. We'll have an update on the market, and then the rest is that Q&A session I talked about, member-driven content, questions, site demonstrations, etc. Reminder, I'm always happy to prepare slides ahead of time. Just send in a question and say this is for the webinar, or reply to the webinar invitation. I have a couple we got today, so we'll get to that. So first things first, what is going on at Investors Observer? Some of you probably have been invited to join a beta program for our portfolio tool, portfolio analysis tool over the last couple of weeks. That is going live for everyone tomorrow. You will be able to see it. Let me find the right window. You will be able to see it here on your Investors Observer. You can just click there. It'll ask you if you want to link an account. You'll say yes, pick your brokerage, enter your broker's the username and password you use to log into that account, and then it will get linked up. You can get an analysis of all the stocks in your portfolio using our scoring system. The linking is done through a service called Plaid, which was acquired by Visa earlier this year. It has, bank level security. Investors Observer never actually touches your account credentials. Those get stored on the Plaid side, and then the just the data about your holdings gets transmitted to us. So please go and check that out tomorrow. I don't have a time, but I am told it will be tomorrow morning. So we have that to look forward to. And so with that, on to the market update. So this is our regular chart, 1 year daily candles. We talked last time about some resistance forming in this area. We have broken out well above that now. We had no real problem with the big round number at 3,000. 3,100 didn't seem to be a problem this morning either. We do have this sort of peak here, which lines up with some peak back here, which could be some resistance, but we'll see. I don't know. Nobody's really able to explain this market and why it does what it does at this point. The NASDAQ 100 closed at an all-time high today, but as we'll talk about a little bit on the next couple of charts, 41% of the NASDAQ 100 is Apple, Microsoft, Amazon, Facebook, and Alphabet. So that's that's 41% of those 100 stocks is those 5. So yeah, they're not everybody is sharing the wealth here. So this is year-to-date performance for the S&P 500 standard, which is the white line. It's weighted by market cap. And then we also have the S&P 500 equal weight, which is the, let's call that blue line there. And that is basically all 500 stocks from the S&P 500, but at equal rankings and not weighted for market cap. So what this shows you here is the bigger companies in the S&P 500 have outperformed sort of the average company, if you will, by about 5% year to date. If we go look since that March 23rd bottom, it ends up, it's closer to 6% in terms of the outperformance there. And that has closed up a little bit. We wrote last week, I think Friday, in our weekly market wrap up about how we were seeing some rally from some, banks and some other sort of unloved names. That seems to have paused a little bit in favor of things going back toward tech here recently, but that sort of action has helped close things up a little bit. All right, so what else is happening in the economy and the stock market? Uncertainty is everywhere. This has become our standard first talking point at this point. Yeah, we seem to be sort of right at a point where both the onset of the crisis and the first wave of reopenings have really moved faster than the sort of normal monthly pace of economic data, which makes it really hard to know what's going on. And yeah, right, the data is backward looking. We were always talking about what happened last week, what happened last month. In some cases, some data series, what happened 2 months ago. Whereas the market is forward looking, right? The market is about what happens in the future. And so people have started to look at a lot of what I'm calling alternative data. The TSA has started posting sort of its daily passenger screening numbers. There have been some big increases there in terms of, a couple weeks of double-digit gains, but that's coming off a very low base. And so it's down, the average number of passengers screened over the last 7 days is down roughly 87% from where that was for, the same 7 days a year ago. And the TSA does adjust that for day of the week. And then OpenTable, which runs a lot of restaurant reservations and some of the payment systems, shows that restaurant activity is down 83.5% in the US from the year ago for yesterday. And it's been about at that level. It's come up from where it was in, the beginning of May, but it's been about that level for a week or so. But the thing to remember here is reopening is a process. Okay, so for example, Virginia, where I live, is moving into what we're calling phase 2 for most of the state on Friday. And so what that means is restaurants will be allowed to have 50% occupancy indoors in addition to outdoor seating. Gyms will be able to open at 30% capacity, and social gatherings of up to 50 people will be allowed as opposed to 10 where it is now. It's really difficult to know how to bake that into any sort of model. Restaurants are generally not profitable at 50% occupancy. You can move some things around, right? You probably have to have less staff. You probably buy less food if you're expecting 50% occupancy. But a lot of places that may not cover rent. So it may help restaurants put something toward rent, which this has been an interesting discussion we've had here. We'll talk a little bit later about sort of the job, the job market. But generally, you would expect, right? You expect a faster rebound if people don't lose jobs, right? Even if people go for a while without getting paid on a furlough or something, if there's an employer at the other end of the phone who can call them up and say, hey, it's time to come back, let's go, that ramps business up a lot faster than having to have a hiring process. So that is that's something to think about. And then, obviously restaurants and landlords have a similar relationship. If you're a landlord, you'd probably rather have a tenant who maybe can't pay rent right now, but is really excited to get back to business where he can pay rent, as opposed to having a vacant space where you got to hire, first you got to fill the space, and then you got to do all the other things, right? The costs to you are the same between having a tenant that doesn't pay rent and having no tenant. The difference is in terms of how fast can you start collecting rent. Having a tenant that's not paying currently is going to start paying a lot faster than having an empty space that you then have to outfit to put a business in at some point. All right. So what else is happening? China and trade is sort of a weird simmering thing there. China hasn't been making agricultural purchases at the level they agreed to in that phase one deal. The White House so far isn't moving toward changing the phase one deal. My analysis is that this is a political calculation. They have these programs that they set up during the trade war to pay farmers, basically. And so I think the political calculation is it makes sense to keep paying farmers and keep the tariffs off, because the tariffs are not good for the stock market and generally hurt everyone in the economy. A new wrinkle to this is the Hong Kong situation. China has moved to restrict, make Hong Kong less of a democracy. The U.S. changed the status of Hong Kong. It may have some, wide-ranging implications for sort of Hong Kong's status as a business hub further down the road. I don't expect it to have any real impact in the next couple of months. China retaliated by canceling more agricultural purchases. But again, we heard nothing from the White House about needing to, make up those agricultural purchases, or there would be additional, tariffs or anything else. So we'll see what happens there. This administration has been pretty unpredictable, but the impact of the tariffs was pretty negative, and the impact of removing the tariffs was pretty positive. And if they're happy just cutting checks to farmers through the ag department, that politically may make the most sense. Yes, so we got the ISM non-manufacturing index this morning. It was somewhat similar to the actual manufacturing index that we got Monday. We wrote about that in our Market Week Ahead blog post Monday morning. Non-manufacturing sector, like the manufacturing sector, is shrinking, but the rate of shrinkage was slower in May than it was in April. The one interesting thing from this is that inventories were very high. Typically what that means is you're going to see less orders to manufacturers until you work through some of that inventory. Think about running a store. If you sell whatever it is, some kind of widget, if you have a store full of widgets, you may not need to order new widgets quite so quickly. You may wait and sell some of that inventory down. So that's the reason that high inventory level is important. What about jobs? The May unemployment numbers are due out Friday. The forecast is for a loss of 8.5 million jobs and an unemployment rate of 19.9. We'll be paying attention to, in addition to the headline numbers, a couple of other things there. One is the shift in temporary status. There were a lot of people in April who said they were on a temporary layoff, or they were unemployed temporarily, something like that. Be interesting to see, one, how many of those people go back, and two, how many people remain unemployed but have a different status this time through. ADP was better than expected. ADP is a private company that processes payrolls. They're pretty big. They usually do an estimate. They said the economy lost 2.76 million, and the expectation for that number was somewhere around 8. So potentially that's better than expected. The ADP series is both rather noisy and has been kind of hard to model in the past. So it's an indicator, except for when it doesn't work. It's kind of how I feel about that, and whether or not this is that case, it's hard to tell. The other thing we're watching for is what's being called sort of second wave unemployment. The first wave was service sector, right? Businesses that had to close and people who can't work from home. Your retail workers, your restaurant workers, things of that nature. The second wave is caused by cost cuts, essentially, right? That's supervisory employees, professional services, people in finance, real estate, things like that. Bloomberg is estimating that close to 6 million jobs could be affected here, but this is sort of a thing that may have started in May, but we expect the second wave to sort of go on for a while. It's not going to be as sharp as the first wave, where millions of people lost their jobs in like 6 weeks. So that brings us to something else we'll be watching in that unemployment report, which was, if you remember, wages, right, the average hourly earnings went up for April. And that was basically because so many of the people who lost jobs were those frontline service sectors that are at the low end of the wage scale. May's average hourly earnings could go down sharply for the same reason, but may also go down because some of these higher paid supervisory and professional employees start losing their jobs. So that's going to be sort of a lot of noise in people's models and analysis, but something else that we'll be trying to pay attention to. All right, so we talked last time we did one of these about an output gap, which I left the definition and my little hand-drawn diagram up here. An output gap is the difference between an economy's output and its potential output or capacity. So the white line here is, let's call it potential output, right? So this is our economy up until the pandemic hit. And then you have some loss of economic activity, right? Your economy stops producing at capacity and falls. And so then the output gap is the difference between the current level of economic output, typically measured by something like GDP, and the potential, which is the trajectory you were on before. So the CBO put these numbers out earlier this week. And so here, though, the difference between these two charts and my chart over here is the baseline of 0 here is horizontal. So this is, right, their model actually assumes some growth. But this is saying that we're looking at an economy running at less than expected GDP out to 2030. And the total difference, right, over that time, if you were to add up this gap for all of these time periods, comes in at somewhere around $16 trillion. This is a forecast. It's not necessarily going to happen, but it's also not out of line. It doesn't seem to be an unreasonable expectation. Hopefully we can get back to work faster than that. And the cuts will be less bad and less long lasting, but we will see. All right, into the questions. Let me see here. All right, let's go through these and then I'll get to those. All right, so the first question we have was from Sal. He said he was curious if we believe it is sometimes a good idea to close a covered call or cash secured put trade early, either to stop the bleeding when the underlying moves against you or to lock in profit if it's early in the trade and the stock moves higher, giving you a opportunity to lock in a larger percentage, but maybe not all of the maximum potential profit in a small amount of time. Locking in profit is never a really bad idea. What you're going to do in that covered call is sell the stock and repurchase the call that you sold. Absolutely a thing that can work. What you're going to want to look at is either the extrinsic value of the sold call, right? You're essentially, right, a covered call works by that extrinsic value, which is basically the time value going to 0. And so if the stock goes way up and that call gets pretty deep in the money, that will also push the extrinsic value down pretty quickly. So you're going to want to look at that. If it's still pretty high, close to where it was when you bought it, maybe that's not a good call to close. But if that gets low, the other way to check this, if you don't have access to extrinsic value, is to just check the net cost of exiting, right? Selling the stock and buying that call back. If that net cost is close to the strike price of the sold call in your trade, that's going to mean that the extrinsic value has gone way down. At which point, yeah, it's certainly reasonable to go ahead and do that early, especially in our new sort of zero commissions world. It likely makes even more sense with puts, is just because there are fewer moving parts. As to if the stock moves against you, that one can be harder. Certainly, it is the case where if the price of your sold call goes way down, you can buy it back and then look at selling another call if the stock bounces. That's the thing we've done here some number of times. So that's the thing to do. Getting out of a stock is always a hard decision. Having that sold call makes it a little bit more complicated, because what that means is you're staring at a position that's underwater and you have to pay to close the call side of the trade usually. So that's right, like paying to close a trade for a loss is never particularly pleasant. So that is another thing to think about, but it's not necessarily, yeah, it really depends on how you feel about the stock. The thing that I have told people some number of times is, if you're looking at a position and you're saying, well, I wouldn't get into this today, well, maybe that's a good reason to not be in it anymore today. Then, if you would make a new position in it today, a lot of times have some questions about why you own something, unless you have a particular thing that you're looking for. All right, next question. What are the criteria used to rank sectors and industries on the top 5 page and in the market week ahead post? So, the market week ahead post uses well, let's get these in the order that I have bullets for them. The top 5s is using the overall score, and the market week ahead uses the sentiment score. So the sentiment score uses the last 5 days. It isn't so much as the net change over the last 5 days as we have an algorithm that considers where the stock is trading currently, or where it was trading at the close yesterday in a 5-day range, and then uses the sort of trend in volume over that time to sort of adjust it further. And the way we do these scores for a sector or an industry is to basically aggregate every stock in that group and try to find basically an average score based on that. So let me go back to the website here and show you the 2 things we're talking about here. So on the stock dashboard page, we have these, top 5 lists, most searched, highest overall score, stocks that posted the biggest gain in score from day to day, et cetera, and then sector and industry. So the top sectors here are healthcare, technology, basic materials, consumer defensive, industrials. These are the sectors where the average stock has the highest overall score. And then the other piece that we're talking about here is in our market week ahead post that gets posted every Monday afternoon. Down at the bottom, we post both a list of all 11 sectors ordered by sentiment score. This is that 5-day metric I was just talking about. And then both the industries, the top 10 and bottom 10 industries by sentiment score. So silver did really well last week, whereas retail REITs not so much, is what that's telling us. All right, so those are those things. And yeah, that overall score combines our fundamental score, long-term technical score, and the short-term technical score for all the stocks in a sector and industry, and then averages them together, so you get some idea of what which sectors and industries are performing well on that sort of overall basis. All right, this last question was from Catherine. She said our option trade section on the website lists optimized vertical trades or an iron condor, but because the markets can be volatile, a lot of times when the market opens, the underlying stock has already moved, sometimes even crossing the break even for that particular spread. Should we continue with the recommended strikes, or do we need to adjust them up or down according to the actual market price at the day? I'd like to know how I can understand the suggested strikes of spread trades and iron condors. So certainly adjusting trades is fine. Typically the way I would do that is find one that has a similar relationship between strike prices and stock price. So, if the strike price on our trade was $2 out of the money and the stock is up $5, find a trade that's the same strike width. Right? If it's a $2 spread, you don't want to, change to a $5 spread. But if you find a $2 spread that's $2 out of the money, that's probably going to be a pretty similar trade. You should also probably look at the, either the credit or the debit there to make sure that those are similar as well. But that is the way that I would adjust that trade. This gets a lot more complicated for iron condors, but the thing that I would point out is iron condors are a bet that a stock will stay in a relatively narrow range. And so if you're looking at a stock that's being very volatile like that, it's probably just not a good candidate for an iron condor at the time, and you should maybe, you can try to adjust the trade, but also maybe just, look elsewhere for an iron condor. All right, so those are the questions we had ahead of time. Thank you to Sal and Catherine for sending those in. Let's get to what people have submitted during the chat. All right, so Jacob says, can I explain how to add an external account? So Jacob, tomorrow you will have this icon right here on the site. It will say My Portfolio, and I think this beta is going to change to New. Just click that, and there will be step-by-step instructions for how to do it. I don't have a test account linked, is the only reason I don't show you that right now. I have a bunch of my personal accounts linked that we were using for testing, and I prefer not to share that information with everyone. All right, let's see here. So I'm not sure. Yeah, Sarbelio maybe. Wanted to know something about charts and price volume trend. We have some of that available in this chart here. This is, TradingView actually provides this chart. But yeah, there are some price, you can add price and volume trend to the chart like that. And some of those other, things that popped up there in terms of the price oscillator, accumulation, distribution, those are all sort of price volume trend indicators. You can add those, just click on this little F with an X, and there's a pretty big list of indicators that you can add to any chart there. All right, so Gibran says, if you're investing for the long term, should you just invest in some value and growth companies now? Should you wait to see if there'll be a second wave of COVID or a dip in the market before investing? Market is currently bullish, but for how long? Yeah, okay. I mean, this one is a hard one to answer. Generally, if you're investing for the long term, market timing is not been historically a successful strategy over the long term. So personally, I'm still making all my retirement fund deposits. They're still being invested. Haven't really made any interruptions to those streams there. I bought at the highs, I bought at the lows, because I'm relatively young and investing for, I have a decades long outlook. So generally, I expect the market to be higher several decades from now than I have at any point over the last 6 months, turns out, right? If that's not how that works, I think we're all in big trouble. But in terms of will there be a second wave of COVID-19 or another dip in the market, the market will almost certainly go down again. The second wave of COVID-19, I have a harder time forecasting. That is what the experts tell me is likely to happen. But I don't know. I also don't know what impact a second wave would have on the economy. I think it kind of depends on where we are in terms of reopening at that point, in terms of what the negative effects there would be. Let's see, Cameron Smith, when are you going to put a trade on? That's a good question. We're looking, certainly with the benefit of hindsight, we could have put trades on, probably several weeks ago and done pretty well. But we are not blessed with a vision into the future. So when we feel like we have a good trade that we can feel good about, we'll be pretty happy to do that. We tried to keep putting trades on for a while when things started to get rocky in February, and tried to bet on utilities and got burned. Everything goes down together in a panic. So we'll put trades on. I'm hoping it'll be very soon. We're kind of pushing for that. We'll see what it will be. But yeah, I'm not gonna commit myself to a particular date here, but as soon as we feel like we have trades that we can feel confident, we'll be more likely to be winners than losers is the best answer to that. So Sobilio has another question. He says, can we show how to use the screener for stocks and how to understand the data where you choose a particular share? Sure. I mean, that is this webinar. I'm happy to talk about the stock screener. It works like any other stock screener. I don't know what particular pieces you have a question about, but I'm here to do that. So the stock screener is under stocks and then stock screener. And so you can screen by all of these factors that are listed here, and then there are more that you can add. You can click on the top of the columns to sort things, right? So if we're looking for, let's go with the high scoring stocks. With, say greater than 500,000 shares traded, right? We're not looking for anything super small or super volatile. We'll do large cap, but not the mega caps. We want some positive PEG ratio at least. And let's say rated strong by analysts. We get all of these. Let's look for a high fundamental score here. That gives us only 2, and that cut the number down pretty far. So let's say let's say we want it to be ranked well in its sector by analysts also. We just added that column over here, and then we can sort by that. See that Centene scores 60, better than 60% of the scores in the stocks in its industry. Let's get rid of that. There we go. Yeah, so American Tower scores 85, better than 85% of the stocks in its industry. Lowe's analysts like it better than 83% of the stocks. Something like that. I don't know exactly what it is. Yeah, it's hard to answer that question without knowing what kind of trader you are or what kind of strategy you're looking for. So it's, yeah. So, the screener can support people who are looking for, looking to build a portfolio of buy and hold stocks with a timeline of years, or people who are trying to do swing trading, right? Like we have metrics that support those two extremes and sort of everything in between. So we can do all kinds of things. So the portfolio link and the watch list are different. Right now, the portfolio link will pull in data from a brokerage account or some other type, some investment account at a financial institution, and then give you, a view of, give you our analysis of it. The watch list is just stocks that you can add. Yeah, you can add a list of stocks to the watch list for sort of quick reference. Oh, let's see. Kavork says, "Where do I see gold going?" Yeah, it's definitely run up quickly. I don't know. Gold trades on its own thing. It's the fact that it's run up quickly is kind of interesting because that's typically a what they call a sort of risk-off trade. In the sense of it's a thing people buy when they're worried or fearful, which is not when they're buying stocks, but stocks have also run up pretty quickly. So I'm not really a commodities trader. And certainly if I was, I think, I stay away from a lot of stocks for the same reason I stay away from gold, which is that a lot of people involved seem to have very firm opinions about the value of the investment, whereas I tend to be more of a pragmatist. Things where people who are trading on faith or some other kind of belief are just less predictable and easy to trade than things where everybody's sort of a pragmatist or trying to make sense of the information at hand. All right, so Srini says he sold a put on DocuSign yesterday, but it went negative, and so he closed it for a loss. How do I understand the options rating by InvestorsObserver? Decide or stock or option. All right, so let's look at DocuSign first of all. All right, so for any stock, you can go and look at the option trades here. So this is not the trade that was on yesterday, so I can't really say what that says, but it doesn't look like it should have lost much. So the things to consider when you have a short put is this amount at risk number here is essentially your break even. And so if the yeah, the stock has to fall. Let's see, this is at 146. It's a pretty long way. So you can be negative on the put position and still be above your break even is one thing to consider. And this trade, like the covered call we talked about earlier, it's a trade where you're short the option. Okay, so you're betting that the price of the option will go to zero or near zero. In this case, that happens next Friday, as long as DocuSign is above 145. If DocuSign is below 145 next Friday, what happens is this option gets exercised, the stock is put to you, which means you're going to buy it for a price of 145. But because you got a credit of 829 when you sold the put, your break even is actually 136. So even if the stock is put to you, so the stock falls below 145, you do have to buy the stock, which can be expensive. But you can own the stock at below the current price of this. Stock falls below 145. You can, have those shares put to you and sell them for, anything above 136.71, and you're still actually profitable here. So that is the thing I would tell you to do there. And then, in terms of how to find a trade, really there's a ton of ways to find a trade. You can use the stock screener we were just talking about to screen for stocks. And then once you find a stock you like, let's go back to sorting this here. Let's say I like Lowe's. I can click on Lowe's from the stock screener and go see the option trades that are available here. We also have a screener for option trades. So if you don't have a stock in mind, but you have a strategy or some other set of criteria you're interested in, let's start this over. Right, we can say I want short puts that expire not more than 3 weeks from now. I want at least a 20% annualized return rate, which shouldn't be hard if you're doing trades that are 3 weeks long. I want 4 keys. So one important thing here is the keys are our evaluation of the option trade. They do not consider the stock. So it can be a terrible stock and still have a high key rating because the options are super close together, you're getting a big credit, something like that. It's a position where it's easy to play defense. So what you're going to look at in that case is this overall score. So a sold put is a sort of bullish to neutral sort of trade. So we're going to want a somewhat bullish to neutral overall score. So let's say overall score above 60. All right, so that gives us 222 trades. You can sort by the columns here if you want. You could say it needs to be at least 3% out of the money. That gets us down to 16 trades. If you want to just, comb through a smaller list, we can also go back here and say, somewhere. Okay. Yeah, so I mean, that's another way to find trades is to look at it that way. Start with a strategy and some characteristics and back into the stock. And either one of those can work. I've picked successful trades either not caring about the stock but knowing I wanted a strategy, or saying, oh, all right, what do we have for a certain stock today? Either of those strategies can work. Let's see here. James says, I missed the start of the call and wanted to hear the covered call part. James, you are in luck. This session is being recorded, and we will send you a link to a full recording tomorrow morning, probably. So that it will happen. Can I use the screener for penny stocks? Absolutely. The stock screener works for anything down to a penny. It turns out it's actually anything that rounds to a penny. So some things that trade slightly below a penny do show up here, but yeah, you can just sort by price, and Berkshire Hathaway is the most expensive stock. And then just, yeah, these guys all are, a penny or less. There are lots and lots of penny stocks in our system here. All right, I think that's all the questions that have been sent in so far. I got another 10 minutes if anybody has anything else. All right, sure. What are the featured and personalized trades? So if we go to the options dashboard, right up here, we have what we call our featured trades. These are trades that we have some, some additional criteria that goes into sort of narrowing down a list of stocks and then finding covered calls, or occasionally a short put will show up in there. But it's typically covered calls in the features trades. There's 3 of those every day. They're, relatively high return covered call trades. And in the personalized trades, we have our 3 basic strategies of covered calls and puts, diagonal spreads, and vertical spreads. And then we have tiers here for whether or not you're looking for something that's more conservative in one of those strategies, something that's sort of in the middle, or something that is aggressive in one of those strategies. And those are new on the options dashboard every day. Do we have other training available on the site? So the Help Center has a number of helpful articles in terms of getting started with stocks, getting started with options, profile and billing. And the stock stuff, we have stuff about our products, we have stuff about investing. Options, we do the same thing. We've got some real basic, like what is a covered call? And then we've got some more stuff that's like, how do I use the website? Those are the bulk of the training that we have available currently. We do have a backlog of recorded webinars. Currently, they're a little tricky to find. You have to go through the pages of the featured news category, but we're hoping to have a better way of organizing those soon. Sabilio says, what is the difference between Investors Observer Free against Investors Observer Premium? So we actually have 3 levels of paid service. The premium service is the lowest level, and that is just our stock stuff. And so, sure, let's go back to DocuSign here. At the free level, you get the overall score for every stock. At the premium level, you get all these other scores. You also get more data unlocked in the stock screener, including all those other scores. You also get more news. So like this insider activity and the analyst actions are not available at the free level. And there are some other news pieces that we don't have in a broad category, but yeah, there are more news pieces about stocks that are available at the premium level. Up from the premium level, sort of in the middle, we have the covered call package. You get everything that's in the stock tier there, plus what is, anything that's on the website that deals with covered calls or short puts. And then the elite level, you get everything, which is all the things that I've talked about already, plus the vertical spreads, iron condors, and diagonal spreads. So what is the best option strategy to choose on Fridays to expire worthless? It's hard to know exactly what you mean by that question. In terms of like, are you trying to make a trade Friday morning that will expire worthless Friday afternoon? That, yeah. I mean, probably selling puts is an easy one there. However, right, you're looking at if you sell it, you know, if you're selling something at 9:30 in the morning when the market opens, you're talking about 6.5 hours of time value, which is not much. So that's you're day trading at that point, right? And so you are taking on a lot of risk, and for you to be able to sell a put that has any kind of real value to it at all, it's going to be either real close to the money, which means you have to be right about the direction of the stock, or it's going to be something that's pretty volatile, which is a different way of saying you need to be right about the direction of the stock. So Billy, I'm not sure exactly what you mean by level 2. We don't have level 2 quotes available anywhere. I'm not sure. Yeah, if you want to follow up there, I'll be happy to answer. Atif, we don't have a full record of insider activity. We have a lot of it captured in our news feed here. And so, yeah, you can see it there. But we don't, we're not pulling in all of the Form 4s or whatever in terms of seeing the insider activity. But, if you just want to check every day, then you can look there. So what do I think about trading after market hours, and what are the downfalls? I mean, yeah, so trading after market hours is a thing. I don't know. I don't necessarily understand the reason. I mean, I've known people who did it, known people who made money doing it. But it's extremely speculative and right, can be risky. So what happens is after hours, there's just a lot less volume. And so what that means is a lot less liquidity. And so things are very, very volatile typically in the aftermarket. There are no limit orders. There's no stops. And yeah, there's no market making either. So your offer to sell has to hit somebody else's offer to buy exactly. And yeah, I mean, for that reason, it's yeah, I mean, if that's what you're into, you can. But in terms of just being sort of a regular investor, right, I don't necessarily see much of a need to do it. I mean, I've seen strategies like, buy the earnings report and sell before the conference call starts, right? Things like that can work some number of times, but yeah, they can also go horribly wrong. And so that's not it's not a strategy that I particularly go in for, but if I wanted to do something sort of at that speed in the evening, I think I'd probably play video games. But yeah, to each his own, I suppose. Okay, yes, Arbilio, we don't have level 2 quotes available anywhere. We may get that at some point in the future, but currently not available. Best option strategy to trade Tesla. Again, good question, and it depends on your opinions, right? Like we try to service all comers here. So we have all 7 strategies available for Tesla. Covered call, short put, bullish diagonal, bearish diagonal, bullish and bearish verticals, iron condor. The covered call and the short put have a lot at risk there. Just in terms of the amount of cash required, you have to buy 100 shares of Tesla, which is an almost $900 stock. That by itself is a little bit out of range for a lot of investors. Short puts, a lot of times, you don't need to hold the entire amount at risk in reserve, but it's a big chunk of change. The diagonals get a little bit better. This still gets multiplied by 100, but it's a lot less than the full amount you need for a covered call. Generally, I think making decisions about an investment based on the stock price is probably not the wisest move. You have a good feeling about the stock as opposed to just as the stock you can afford. But yeah, and then so verticals are sort of the lowest cost in terms of amount at risk. They're also the highest, the highest risk, but they have the highest reward there also. So here you get 46% return rate. That's not bad in terms of the risk to reward ratio there, right? You're risking 341 to try to get 159. So that's, approaching 2 to 1. That's, not terrible for something like Tesla. The bearish vertical looks a little worse just because of the way the strike prices fall. But yeah, I can't recommend a particular trade on Tesla just because it's not what we do here. But certainly if you're interested in one of these strategies, I think we probably have something that's close to what you're looking for there. All right, it is getting to be about the end of our hour here. As I mentioned earlier, this has been recorded. We will be sending out a recording and a link to the slides tomorrow, probably in the morning. Our next workshop is, let's see, Kevork says June 24th. That math checks out in terms of being 3 weeks from today. So look for an invitation to sign up and come join us then. In the meantime, look for that portfolio link tomorrow. Please let us know if you have any questions, problems, anything like that. Yeah, if you need us anytime between now and June 24th, we're reachable by phone or also this help button on our website. So yeah, you can get a copy of the recording. It will be emailed to everybody who registered to come today, and then it'll also show up in the featured news section of the website. So with that, thank you all for coming and have a good evening.